We're going to calculate the stock price for Visa, and we're going to do that using prior financial information. So let's get the market cap 428.862 billion, and they're trading at 195.24. Now to figure out the shares outstanding, we just take the market cap divided by the stock price, and we get the shares outstanding, which is 2.2 billion. Next is free cash flow. And the best way to calculate the stock price for a company is to estimate future free cash flow, then discount those numbers back to today's dollar amounts. And that's what we're doing in this video. So free cash flow. We also need net income, which could be found on the income statement. That's profit or loss for a given year. And we're using 4 years of financial information to do our calculations. Last is revenue, which is just the sales for the year. And it's good to look at numbers just to see how they're moving. Revenue is a nice incline year after year, which is really good to see when investing in a company. So is net income and free cash flow. It looks pretty stable so far. Now, next we need to look at the capital structure of Visa and figure out the discount rate we need to apply to the future cash flows. So the interest expense on the income statement is $500 million. That's the interest Visa pays on its debt. Next, we need liabilities. So current liabilities is none. Long-term liabilities is $16 billion. That's all the debt that's due beyond 1 year. So they pay 3.2%. Now, interest is tax deductible. So we want to find the effective tax rate to see what we have to discount the interest by. So the income before tax is $15 billion. And the income tax is $2.8 billion. So they pay 19% of taxes. So the cost of the debt is actually 2.6%. And you can see that capital structure is made up of 4% debt, which is pretty good, really good. You don't want to have too much debt. We also need to figure out the cost of equity in order to calculate the discount rate. So we need the beta, 0.92, which is a good, very good beta. A beta of 1 means the stock moves with the market. So as you can see, the cost of equity is 9.4% and the cost of debt is 2.6%. So equity is more expensive than debt because equity sits lower in the capital structure of a company. Therefore, it's more risky. In the event of a default, debt holders are paid before equity holders. So greater risk, greater reward. Now, this number, 9.13%, this is the price Visa pays to obtain financing. So Visa needs to generate that percent in profit a year in order to add value to its investors. And that's our discount rate, and we call it the weighted average cost of capital, which is a blend of the cost of equity and the cost of debt. So we're going to discount the future cash flows by that 9%. We calculated the free cash flows of 4 years, and then we did a terminal value, which is an estimation beyond 4 years, every year after that. And we used the Gordon growth model to figure that out. We discounted those numbers back to today's values. And then the sum is $230 billion. That's the sum of the value of the company. And then if we divide that by 2.2 billion shares, we come up with a stock price of 105. And it's trading at 195. So this is considered a sell. It's trading at an 86% premium. Let's look historically. If it was trading at 105 at any point, maybe 3-4 years ago. So it's been trading at a premium. And this can happen a lot with stable companies. They're trading at a much higher price than they're worth because people perceive the company as more valuable than it is. So stocks can obviously trade higher or lower than intrinsic value, but the stock is predicated on the supply and demand of the market. The more people who want to buy a stock, the higher the stock price becomes. The more people want to sell the stock, the lower the stock price becomes until the price is met. And if you do research on any company on Visa, you may find analysts that mention this is a buy stock, you should buy Visa. Other analysts may mention this is a sell, that you should sell Visa. But each analyst uses their own model and their own assumptions. But you never see their model. This is my model and my assumptions. And I hope you liked the video, and thanks for watching.